Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you today. And as always, send your questions to Brian Rezny at ReznyWealth.com. And make sure you visit ReznyWealth.com. Download any of our groundbreaking reports. Number one downloaded report right now, 3 biggest risks you must avoid for 2025 if you care about your wealth and your retirement. We also have an updated retirement success calculator at ReznyWealth.com. So if you're concerned maybe about the advice you're receiving, maybe you're concerned about certain investments in your portfolio or that you're positioned correctly, go to ReznyWealth.com. You can take a free retirement analysis by my staff at ReznyWealth.com. Again, your retirement success is important to us, and it should be to you. Let's talk a little bit about the U.S. economy and what you should know. Number one, don't be short-sighted. The Fed is currently embarking on an interest rate decrease mode. Remember, they started increasing rates a little over 3 years ago, and that really basically tried to hit inflation, which was a major problem in the U.S. that was created by the current administration. But inflation is now abating because all the free money that was printed and given out to the U.S. consumer has pretty much been spent. So now the economy is slowing a little bit, not drastically, but a little bit. So what the Fed does now is they start reducing rates in order to stimulate the economy. The main driver that I want to stress to every one of you investors is you want to watch the unemployment numbers. If people are working in the U.S., the consumer spends money. If unemployment numbers go up a lot, which they are not at this point, but if they do, that would be a sign you may want to lighten some of the exposure you have in risk assets in your portfolio. We look at the unemployment numbers on a regular basis, but we look at a lot of other factors too. But again, if the consumer has a job, they're often spenders in the U.S. economy. Right now, we're looking at the U.S. economy growing about 2.5% this year. And ultimately, I want to make sure every one of our listeners today understand, never be an emotional investor. Remember, if you're an emotional investor and you're making emotional decisions, investments, your portfolio will fail 100% of the time. Don't have knee-jerk reactions. Don't jump around too often. Volatility is normal. And just remember that. In your quest to build a portfolio and grow your return and your net worth, you have to realize you're going to go up 4 or 5 steps and come down a step or two occasionally. That's the normal part of investing. And as always, all investment assets have risk, not just the stock market, but we saw bonds get pummeled over the last 2.5 years when the Fed started raising rates initially. So again, remember, all assets have risk. Some assets you want at certain parts of the cycle, other assets you don't want, and you may want to actually add cash positions depending on your risk profile and goals and objectives. Let's talk about general market correction and why you need to stay calm and not panic sell. I've been managing money over 30 years. One of the most important aspects of managing money is staying calm. As a professional money management firm, Rezny Wealth Management manages a lot of money for a lot of clients. We need to stay calm and we need to make decisions for our clients that are non-emotional. Now, managing money over 30 years has taught me one thing: learn from others' mistakes. I will often have a lot of calls from my TV and radio show from callers just like you, and some are really emotional, really calls out for help. People that have sold when they shouldn't have sold. People that have bought investments they should have never bought. So the emotions run rampant on both sides. Ultimately, if you stay calm in market corrections, you'll probably come out the other side as a big winner if you're properly positioned. Another big aspect, review your assets in your portfolio. Anytime we get a short-term market correction, and remember, throughout any calendar year, we have a 10 to 12% correction in most asset categories at least once. We have 3 to 5% corrections throughout any calendar year in almost every asset, multiple times, 3, 5, 10 times in a calendar year. When we have these short-term pullbacks, that is a great time to either add to quality investments you have in your portfolio if you're holding cash, or upgrade positions in your portfolio, maybe sell certain things that maybe are no longer as viable as other assets you're looking to purchase that have better opportunity. The other big winner right now is going to be the bond market, and I've talked about this for about 2 months. Remember, and in anticipation of the Fed reducing rates, when the Fed reduces rates, bond values go up. In anticipation of that, the bond market already started to do quite well. In fact, if you look at returns for long-term bonds over the last 3 to 6 months, they've actually done quite well. We see that trend continuing because remember, when the Fed starts reducing rates, bond values have a chance to go up. There will be a point where you do not want to own long-term and international bonds again, but I think now for a percent of your bond exposure, it makes a lot of sense. We've already made those changes in our managed accounts at Rezny Wealth Management for our clients because, again, we're an active money manager. We're a timely money manager. We make adjustments for our clients because they're hiring us and paying us to manage their money properly. So again, you don't do knee-jerk reactions. You look at what the data is coming out and you make those adjustments as necessary. Phil from Fort Myers. Is Tesla stock a good buy at its current valuation? Phil, excellent question. I like Tesla the car. I like Tesla the company, but I do not like it necessarily as an individual stock purchase. I think Tesla is grossly overvalued, and I think there's better places to put your money with better growth of earnings and revenue, which ultimately is a big driver of stock appreciation. So I would look for greener pastures, and Tesla's just not it. Olivia in Naples, Florida. What are the pros and cons of target date funds for retirement planning? So let's explain what a target date fund is. A target date fund is a mutual fund that basically really has kind of a static portfolio. It's going to have a helping of stocks, it'll have a helping of bonds, and that ratio of stock to bond will be dependent on what target date you pick. So if you pick a target date retirement, let's say 2030, that fund assumes you're going to retire in 2030, so it allocates money between stocks and bonds based upon a percentage, and it's kind of a computer-generated percentage, to be brutally honest. I do not like target date funds. I think they are too stagnant, they're too buy and hold, set it and forget it, and the expense ratio typically is high. What I'd rather have an investor do is how we manage money. Be a little more nimble. So whether a client's retiring in 3 years or 20 years, we want to be nimble in the fact that we're making adjustments to that client portfolio, not only around retirement needs and goals and objectives, but also you need to be nimble around the economy and the cycles we're in. Target date funds simply do not do that. So for that reason, not being nimble, not being timely, more of a set it and forget it approach is how I would describe these funds. I would not invest in those. I think there's greener pastures elsewhere. Leah in Naples, how will inflation affect my cryptocurrency portfolio? That is an excellent question, by the way. We've got a lot of questions on cryptocurrencies over the last 4 or 5 years. One of the things I want to stress about cryptocurrency is if you go back 4 or 5 years ago, before the hyperinflation we had that was set on by the Biden administration, unfortunately, that really hurt a lot of Americans, the big talk from all the cryptocurrency experts, and this includes Wall Street, which of course is always wrong, said cryptocurrencies were going to be a hedge against inflation. But what happened when inflation reared its ugly head under the Biden administration, basically when we had the highest inflation in 40, 50 years? Cryptocurrencies tanked. So cryptocurrencies are not an inflation hedge at all, and cryptocurrencies are really a speculation investment. There's nothing there. So as an investor, I cannot recommend cryptocurrencies. You're basically buying a bunch of nothing. You're buying air that you're trying to grab that you really ultimately can't get. I think investors need to realize that cryptocurrencies are risky assets that are speculation, kind of like Ponzi-type bubbles. And you, the investor, need to realize that if you get involved in cryptocurrency, you're basically buying a lotto ticket and your chance of winning are slim to none. I'm going to take a quick break. Send your questions to Brian Rezny at ReznyWealth.com, and make sure you visit ReznyWealth.com, download any of our groundbreaking reports, and as always, make sure you're doing the right thing for your money. And if the advice you're getting just doesn't seem right, you've got a kind of a weird feeling in your gut about your current advisor or firm, call Rezny Wealth Management or visit ReznyWealth.com. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, one of the things I want to bring up is really about the advice you're receiving. We get a lot of phone calls throughout the week at Rezny Wealth Management, people just like you that are looking for a real money management firm because you've got that sinking pit that in your gut that something's not right with your current relationship. One of the things I always try to stress is never settle for bad advice. Unfortunately, a lot of people settle too long. A comment I often hear from new clients, we should have come in sooner to talk to you about managing our money properly. Does this sound like your current relationship? I want to kind of put together a multitude of comments I've heard from clients over the years, people that came in to see us. This is often what I hear if I put it all together. We knew there was something wrong with our investment advisor and the advice we were receiving. Things just didn't seem right. More of a set it and forget it approach than any real advice. We asked our advisor questions, we had concerns, we settled too long. We knew we needed a change, then we met Rezny Wealth Management and we couldn't be happier. I hear that comment from a lot of new clients, and I hear that comment from a lot of people that come in and talk to us about managing their wealth. As again I suggest, never settle. You have one retirement, you have one portfolio. You should never settle for conflicts of interest, bad advice, working with a firm that doesn't legally work for you 100% of the time. At Rezny Wealth Management, we look out for our clients and we always put you first. But with that said, let's talk more about market correction and strategy. I'm often asked, Brian, when a market correction comes, what does your firm do? What does Rezny Wealth Management ultimately do? While market corrections, again, are unsettling, what I try to do is I encourage clients to be calm. So again, educating clients about being calm and about the long-term prospects of that portfolio. So as a money manager, as a real money manager, we are always researching the economy on a daily basis, well before a correction happens. I don't know if a correction is going to happen today or 6 months from now or somewhere in the middle. But one thing I do know, when a market correction happens, we already have a strategy. Our strategy is fairly simple. Because we're already doing daily research on our client portfolios and all holdings within those portfolios, we are ready to deploy cash in the areas that we can buy a little bit cheaper. Or we may have an investment we've been looking at to add to a client portfolio, but we're waiting for a better price. So ultimately, have a market correction strategy. That's what we do every day for our clients. If that's not happening within your portfolio, that would be another cause for concern for you. Again, stress, financial stress, portfolio stress, retirement stress should not be part of your investment relationship ever. And I ultimately believe that you, the investor, need to take charge. Take advantage of those opportunities when opportunities arise, because they don't happen all the time. And remember this. Stay calm. Avoid panic selling. Corrections are a normal part of every market cycle, and many investors unfortunately panic, and it ultimately wreaks havoc in your portfolio and brings down your financial security. Ned from Fort Myers, are ESG funds better than traditional mutual funds for long-term growth? So an ESG fund is an environmental social governance fund. Those are the acronyms for ESG. We're not a believer in buying an ESG fund. We like to look at all investments that are out there. Remember, corporations by law have to do the right thing. So just because a fund has the letters ESG in front of it doesn't mean it's a good opportunity. In fact, they might discard certain parts of the investment market, again, that are legal and valid, but because of their covenants, they don't include those in the portfolio. As an example, oil and gas can be excellent investments from time to time. But ESG funds often will not include them, even though they might be appropriate, because an ESG fund deems that oil and gas is not appropriate because it's not as clean as maybe a different type of energy. In our opinion, again, Companies are running themselves legally. They're doing the right things. And why should a fund that says ESG, again, not have that within its portfolio if it makes sense financially and ultimately is a source of clean energy? So we like to look at the broad spectrum of investments, drill down on areas that have the best opportunity for growth, and then build that into a client portfolio. Brandon from Elva, what should I know about variable annuities for long-term retirement income? Well, the first thing, Brandon, you should understand about variable annuities is they're highly expensive and they're going to take away from your long-term retirement income. Let me explain. I've been managing money over 30 years. I've looked at literally hundreds, if not thousands, of variable annuity contracts over the years. Variable annuities in general work all the same way, so don't think yours is any different. The typical variable annuity that I've reviewed has an average annual expense ratio between 3.5% and 4.5% a year. That's ludicrous. So imagine your portfolio making 8%, and you have a 4.5% expense ratio. You only get to keep 3.5%, but you took the risk of the markets. That makes zero sense at all. Variable annuities are sold investments through brokerage firms, banks, and insurance agents. And they're selling those because they pay lavish commissions to the selling broker, and they pay lavish fees to the broker-dealer or the insurance company. Variable annuities, there's no benefit at all. It's only negatives. Negatives in you have a lot of risk. You don't get to keep the return. You have high expenses. It basically takes away your financial security and your retirement income. What I suggest, never ever buy a variable annuity. Leo from Fort Myers. What conflicts of interest might arise with a fee-based advisor compared to a fee-only advisor? A lot. So let me explain. Almost every bank, brokerage firm, and insurance company does fee-based work. What does that mean? They basically do advisory work in a fee basis. They also still sell commission-based products. What does that mean? Sometimes they're fiduciary if they're in an advisory relationship, but then if they sell you commission products, it's not fiduciary. So sometimes they legally work for you, but other times they don't. All the conflicts that are prevalent in a commission relationship, most of those would be prevalent in a fee-based relationship because they're going to use their house brand mutual funds, funds that they've manufactured, funds that have shelf space fees and revenue sharing. All the conflicts often of a commission relationship will often be prevalent also in a fee-based account. The only firm you should ever entrust your life savings to, ultimately, is a fee-only fiduciary money management firm like a Rezny Wealth Management. By the way, a recent article by the Wall Street Journal, 2% of firms nationally are fee-only fiduciary in the U.S. 98% of firms are commission, fee-based, dual-registered, meaning they're not fee-only all the time. They have massive conflicts, and they don't legally work for you in your best interest 100% of the time. That's a relationship you should never get involved in. And that ultimately is going to have a detrimental impact on your money. One of the things I do want to stress a lot is with every investment that you pick, do your research before you buy it. With that said, I'm going to go to a quick break. When I come back, I'm going to take more of your questions after this. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. One of the most important things that I like to discuss, of course, is what we're doing right now. But remember, as an investor, as a retiree, make sure the advice you're getting is real advice. Again, I go back and cite the Wall Street Journal article, recent article, 2% of firms are fee-only fiduciary. That means 2% of firms in the United States legally work for you 100% of the time. Fee-based firms, commission firms, combination firms, fee and commission, do not legally work for you 100% of the time, that means your interests are not put first, and that means massive conflicts against your financial security and your well-being. But let's talk a little bit about what we're buying now. I think the most important aspect, of course, anytime you go through any calendar year, you go through volatility in the general markets. We've got, of course, as we've talked before, an election coming up. I think investors need to realize making appropriate change to your portfolio is vitally important. At Rezny Wealth Management, we don't believe in just strictly a buy and hold approach, but we also do not believe in moving money around all the time. We do a lot of research, we buy positions, and then we upgrade those positions when they need to be sold because there's better opportunities for the money. But what are we buying right now? We're focusing on high quality investments. I think ultimately, you the investor, when you're looking at your portfolio, stay focused on quality. Quality means larger cap companies within the U.S. marketplace. We currently have nothing invested outside the U.S., and there's a reason for that. The U.S. is growing better than the rest of the world. We're more stable, and I think large caps are a place to be. But not just any large cap. Large cap companies that actually have revenue growth, earnings growth. You want companies that are selling more, that are actually bringing more to the bottom line. Remember, profits matter in stock price. Companies that are making more money, that are dominant players, often their share price will get rewarded as they earn more money. It's not a guarantee, but that's the number one criteria that we look at as a firm when we're adding positions, whether it's a sector or an individual stock in our client portfolios. How long historically, another question that often comes up, does it take for a market downturn to recover? Think about this. We've gone through some bouts of volatility this year, but ultimately what happens in a portfolio is vitally important. How long does it take for that volatility to kind of subside and really for the overall markets really to come back to new highs? It could be weeks, it could be months, it could be years. But generally speaking, think about this. Most 20% pullbacks in the equity market usually are recovered often within usually 9 to 12 months. That's pretty typical. Sometimes it could take longer. But again, a 20% pullback in the equity markets is pretty severe. As I've talked before, your portfolio is a moving target. It goes up 4, 5, 6 flights of stairs. You need to be properly invested when times are good. And it may come down a step or two when times are bad. But you're still up 3 or 4 steps from where it came down from the high. Think about your portfolio the next 3 to 5 years. You want to stair step up. You're going to stair step down a little bit, and then you're going to stair step back up. Your portfolio should be designed to grow. You should be in assets that are high quality, assets that actually have earnings power, and in economic areas and sectors within the U.S., mind you, that really have a chance not only to reward you for the risk you're taking, but hopefully add more structure and more stability to that portfolio. Sophia in Naples, my advisor keeps pushing high fee structured products and mutual funds. Is this a red flag? Yes, it is a big red flag. First off, any advisor who is selling structured products or mutual funds is not fee only. Again, structured products are a commission product. Most mutual funds are a commission product. Even in a fee-based account, which all Wall Street firms do today, they can still get revenue sharing and 12b-1 fees from a mutual fund, even though they don't get commissions. But in general, stay away from structured products. And why do you want to stay away from these? Simple. They have lockup periods, meaning you can't get out of these things if they go south. A structured product is designed often to be around for 5 or 10 years. You can't get out if things change economically. You're stuck basically in jail with that product. You want to have flexibility. There is no reason to buy a structured product. Because why do you want to have your money locked up? Why do you want to have excessive fees? A lot of structured products limit your exposure to the upside. Some will talk a good game about how it limits some of your volatility or downside. But at the end of the day, the more expense you have, which structured products have a lot, the more it takes away from your net return. And again, lockups do matter. So stay away from products, mutual funds, and or structured products that do have these problems. Jack from Punta Gorda, how does NVIDIA stock look? Excellent question, Jack. Fair disclosure, my firm currently owns that stock, and we have added to it as of recent. NVIDIA is basically one of the leaders in the semiconductor area. In general, let's talk about that area as a sector. Semiconductors in general are a part of the technology realm and ultimately are going to be a huge driver of the overall U.S. economy. As an investor, you need to realize that what's going to drive the economy is semiconductors. So should you have semiconductors as part of your overall portfolio, I would suggest you do. But of course, do your own research, have your own investment plan. We've owned semiconductor sector for quite a long period of time. We do own this stock. It is fairly valued, if maybe not slightly valued, but we're not betting on today. We're looking at the next 3 to 5 years. And I think investors need to realize that if you're looking at the next 3 to 5 years, what's an area of the economy that's going to drive all the economy? Semiconductors today are in everything you do. Your cars, your phones, they're part of healthcare. You name it, semiconductors are there. It's going to be a growth driver for not only the U.S. economy, but the world. And I think investors need to realize that. Ethan from Denver. I own 3 robo-advisor accounts. 1 high-yield savings account for guaranteed emergency funds. Is this a good strategy? Ethan, I'm not a fan at all of robo-advisor accounts. And the reason is robo-advisor accounts are just basically a cheaper asset allocation, computer-generated set-it-and-forget-it strategy that Wall Street pushes. Wall Street charges more money for that. Robo-advisors charge you a lesser fee, but it's basically the same animal. The problem with robo-advisors and or Wall Street asset allocation or fee-based accounts, it's basically set it and forget it. Most of those portfolios, it's a pie-shaped chart. They basically go to the buffet of investments. Every part of that buffet is on your portfolio. So instead of owning things that you should own, you own everything in a robo account or in a Wall Street account. There's times you don't want to own bonds in your portfolio because rates are being jacked up, meaning bonds will go down in value. But if you have a robo account, you're always going to have a helping of bonds. If you have a Wall Street fee-based account, it's no different. So one you pay more for, one you pay less, but it's kind of still the same set it and forget it bad advice that I personally think you should avoid. Folks, I'm just about out of time. As always, it's time to lift the weight of financial stress off your shoulders. It's time for Rezny Wealth Management. We do not believe in a cookie-cutter approach, neither should you. We deliver customized investment retirement advice to your unique situation and goals. Honesty, integrity, compassion, and competence. That's the Rezny Wealth Management difference. Never cookie-cutter, always customized advice for your unique needs and goals. Make sure you do visit ReznyWealth.com, download any of our groundbreaking reports, and also if you're a larger investor and you'd like to talk to us about professionally managing your money, click on that consultation tab. Don't settle, get rid of that stress, get rid of that bad advice, and look out for your financial well-being.